Welcome, everyone. Another episode of Financial 15. Kevin and I are ready to go. As always, with these episodes, we're trying to provide some financial knowledge, something you can use to improve your situation. Today, we're looking at the age-old debate. If you have a corporation, do you pay yourself with salary or do you pay yourself with dividends? What are the pros? What are the cons? We're going to go through all of that.
Yeah, this is definitely a topic we want to deal with on the corporate side where, there's always that question. Should I pay myself salary? Should I pay myself dividend? Again, if you want to know more information on this or any of the other topics that we've talked about before or may mention in this video, please go to our website at beckerorr.com, like us on Facebook, or as always, visit and subscribe to our YouTube channel. You get the whole 9 yards from there. So Clint, first we're going to deal with corporation, and then we're going to deal with salary versus dividend. Give us the definition to start with. Let's move from there.
Yeah, we have to mention the type of corporation here because there are lots of types of corporations out there. We're talking about private corporations in Canada. So a public corporation, one you might say you buy a share of on the stock market, not what we're talking about here. Or if your corporation's involved in the US or another country, really not applicable for this video. We're looking at Canadian private corporations. If you have one of those, how do you pay yourself? Do you pay salary? Do you pay dividends? That's what we're getting into. And we should mention it's not a one-size-fits-all. If you're thinking this is going to solve the debate and everyone's going to get salary or everyone's going to get dividend after this video, not the case, because it really does depend on your situation. But let's go through some of the pros and cons of each. I'll tee this up for you here, Kevin. We'll start with the salary. What are some of the benefits of paying yourself a salary from your corporation?
Yeah, well, like we said, we're going to mention benefits on both, and there's going to be some downside on both. But let's start with these benefits here. One of the big things you get with a salary is you earn RSP room. That's significant. It is huge because if you don't have a pension or something, you want to put money away, this is one way to do it. Salary allows you to do that. Also, you're paying into the CPP or the Canada Pension Plan. Again, 21, it's 5.45 up to 61,600. Again, if you want to know more exactly about CPP, we have videos on it. Go to the YouTube channel, check us out on our website. But again, what this really does provide is future retirement income stream, death benefits, and disability. Without that option, not to earn RSP room, not to be able to get CPP, you may not have these benefits going forward. And that could really have a big factor is how your retirement's going to look. And again, the other factor that we want to touch base on, one of the benefits, it's tax deductible expense for the corporation. So this is another one where, okay, we've made this much money. Now I've got a deduction that I can use so that I don't have to worry about paying as much tax going forward. But that's just a few of the benefits, isn't it? There's more to it, isn't there, Clint?
Oh, there's quite a few more. And the CPP is a big one. You want to check out the video where we dive deep into CPP. But some of the other benefits here, it does count as personal income. So it's going to be personal salary that you receive. Dividends often count as investment income, different category here. And some of the perks of having that personal income, well, if you're trying to apply for a mortgage, trying to apply for a loan, often the lender will treat personal income more favorable than income from investments. So if you have multiple years of a nice steady personal income, a nice steady salary, that could be seen more favorable when it comes to lending institutions. Also, maybe you want to get some private insurance coverage, some private disability coverage. Often disability packages aren't going to cover investment income, but they will cover a salary. They will cover personal income. So you might need that salary to qualify for some of those extra insurance if that's important to you. Similarly, our tax system, there are some tax perks where you need personal income in order to claim those particular tax perks. I have two examples there on the slide. Medical expenses, childcare benefits would fall under that category. So if you qualify for some of those, in order to take advantage, you're going to need to have a salary, some personal income, and then you can use those deductions, those credits, etc., against that income. And the last item there, and this isn't for everyone, but for some folks, it's just more of a nice to have. Tax is deducted at source when it comes to salary, which means you don't have to put the money aside. You don't get a big surprise come tax time. It's just a little easier to plan that way. And that is the case when you have salary, not necessarily the case with dividends, but it's not all just roses here. There are some drawbacks to salary as well, Kevin.
Yeah, there are. I mean, there's got to be give and take on both sides. Otherwise, we wouldn't be using the debate in the first place. One of the things that you do have with salary, of course, is you pay personal income tax rates. So if it's a dividend that you're getting, that may not be the case going forward, but you do have to pay your personal income tax. And depending on how much salary, that could be a fairly high number. Now, the other factor is that you have to pay both the employer and the employee CPP as a CCPC, or a Canadian controlled private corporation. That number amounts to almost 11% in 2021. That's a fairly large amount that has to go in there. So it's something else to consider that maybe you don't have to deal with on the dividend side. you must register a payroll account with CRA as well. So, I mean, this way you have to remit these taxes. You know, if you've got a business that's 10 or more people, that may not be an option that you have to worry about as much. But I mean, if you're a really small business with 3 to 5 people, this could be an onerous source that you don't want to deal with going forward. And of course, as a corporation, you must issue a T4 to these people. So these are all sort of drawback scenarios for, well, maybe I don't want the salary and I want to look at it. So there are some perks, there are some cons, but again, these are things that need to be addressed on both sides.
Absolutely. We'll switch gears here. We'll start talking about dividends. Do the same thing. Look at the perks. Look at the drawbacks. Some of the benefits of dividends. Well, like you mentioned there, Kevin, dividends qualify for dividend tax credit. Depends on how the dividend comes out of the corporation, but usually the dividend tax credit means you pay less tax when you get dividends. That's the big perk. You don't spend as much money on tax when you receive the dividend. You also avoid paying both the employer and the employee amounts for CPP because dividends are investment income. They do not qualify for CPP contributions. So if you take money out as salary, you're going to get hit twice as a business owner, both sides of that CPP. You might be putting 10.9% into the plan. You take out dividends, you don't have to pay that extra amount into CPP. There could also be some administrative items that would be helpful. But you don't need a payroll account with CRA in order to issue dividends to shareholders of a corporation. You don't have to do the more onerous T4s. It's a T5 slip, which is a little easier. So in addition to the lower tax, the avoiding the CPP, you could also have some administrative perks. But it's also some drawbacks there, Kevin, for the dividends.
Yeah, I mean, as we said last time, there's drawbacks with salaries, also drawback with dividend, depending on how you want it. So as we've said before, if you run a salary, there is an expense that the corporation can deduct. If you're paying it out as a dividend, again, we are paying money from profits. We are not dealing with a salary basis. So this is not an expense the corporation can deduct going forward. I mean, a salary can be a huge factor for them. If you don't pay that, well, now that deduction's not there. Not only that, but as you mentioned before, Clint, this is investment income. It is not personal income. So since it's investment income, it earns no RSP room. There's no personal income tax credits. It can be used or could be an issue for private disability coverages or loans, as we talked about in the first part with salary as to why some of those things are advantages. So by having this as more of an investment payment going out to you, you eliminate a lot of things that you may be able to get just based on the fact that you've got a salary. So there are some pros and cons with both of them, and these are some of the drawbacks for the dividends.
Absolutely. And something to keep in mind here, folks, we've kind of shown you both sides of the coin there, the salary, the dividends. It's not a one-size-fits-all. It's also not an either-or. You can do both. For example, you could give yourself a monthly salary. Let's say I'm going to need $4,000, $5,000 a month, whatever your number is. And then at the end of the year, depending on how good the business does that year, you can pay out a bonus as a dividend. So you get a little bit of both. You're trying to get the best of both worlds. So that is certainly an option. It's not an either or. And also things could change with time, Kevin, right? You might do one thing during your working career, might do something completely different in retirement.
Yeah, that's exactly it. I mean, during your working career, you may want to have all those benefits, the perks of having RSPs, worrying about being able to qualify for disability and thing insurance, stuff along those lines. And you'll do that while you're working. When you're retired, though, a lot of these things you don't need anymore. So why not just pay the investment up? The interest that we're going to get or the dividend that we're going to get based on that may be much more beneficial to us going forward. So those are definitely some of the things to look at. One thing I will emphasize is, as Clint mentioned, it's not a both or it's not an either or. You can do both and you can combine the way you want to deal with it. I would check with your accountant. They're going to know some of the best options to figure out how to set this up for you. That's important to know. We're going to give you the background, but they're going to know a little bit more in regards to the technical aspects of what's going on.
Yeah, they'll know your situation far better. Of course, they're the ones handling your book, so they'd be the best person to contact for the details for your situation, of which would be more applicable. But you've got some of the background info here that can help out to help get information on which one might be a fit for your situation. And as always, if you have more questions, whether it's on this topic or any topic, we're happy to help out. You can always visit chatwithclintonkevin.com. We'd love to hear from you. We always like talking with folks. Anything else you want to add, Kevin?
No, I think salary versus dividends covered it. We've given you some highlights. We've given you some lowlights. Take it to the accountant, see which one works best. Or again, as Clint mentioned, call us, get in touch with us. We'd be more than happy.
That sounds good. We'll be back again very soon with another video. Take care.